Hi everyone, good morning. This is Kshitij Agrawal. Last year in July 2024, budget was introduced. In that budget, there were a lot of amendments brought in for individuals in respect of the salary income, business income, capital gain income, and other income. I have made a master summary example with actual figures to understand those amendments in a summarized and better way. Before coming to the question, I would like to explain there are two kinds of amendments. One is date specific, or we can call it transaction specific, and one is year specific, like assessment specific basically. What are these two amendments? The assessment specific amendment means that whatever income you are earning during the year or whatever expense you are incurring during the year, you will get the benefit of this in the assessment year. So assessment specific means, like, if you are going to calculate your business expense for provident fund, just an example, for provident fund, then your deduction for provident fund, what income tax will allow, will be assessment specific. If that is applicable during your assessment year, then you can claim that. On the limits, capital gain 1.25 lakhs limit is there. If the transfer is happening during the year, there are some conditions. If the transaction is happening during the year, then while assessing your income after your financial year ends, you can claim that amount for the full year income, not only for the transaction specific, like this transaction is happening after this date. It is for the transfer. There are few changes in capital gain which are date specific and assessment specific. So basically, assessment specific amendments affects you in the assessment year on the whole income or expense for the financial year. Now coming to the question goes like this. Mr. A is a non-resident, non-senior citizen resident individual, and he has following income for financial year 24-25. He earned a salary of 12 lakhs. His employer has contributed towards provident fund and pension fund. Some amount has been contributed. So what does this mean? Whether it should be added to income? No, provident fund should not be added to income. Why? Because the employer's contribution to provident fund is not part of my income. But pension fund, whatever pension scheme contribution employer is making, that should be added to my income, and I have to pay tax on that. So the total salary will be 12 lakh plus 1 lakh 82,000. So it is 13 lakh 82,000. Then he will get a standard deduction of 75,000. So his total income will be 13 lakh 82,000 minus 75,000. We will see in the solution also. Next point is, he entered into two new businesses during the financial year. Now, one is manufacturing of footwear, second one is letting out of house property. Manufacturing of footwear, he is earning 3.2 crores from this business. This means, I mean to say, he is having a turnover of 3.2 crores, out of which 20 lakh is received in cash. Now if 20 lakh is received in cash, then there should be some hit in your mind that he is receiving more than 5% of his turnover in cash. So whether tax audit is applicable on this person or not. This is just an additional check. This is not related to this question directly, but this is just an additional check, and this law is old also. Coming to the next business, letting out of house property. So letting out of house property, this is the amendment in this Finance Act 2024, that if you are earning any income from letting out of house property, then it cannot be treated as your business income. It has to be treated as your house property income only. Why? Because earlier people used to claim all the expenses against this income and show it as loss or zero income. So this practice has been curbed out by this amendment, and in this question the person is earning 56 lakh income and municipal taxes of 75,000 is paid by him. So municipal taxes will be allowed. That is not an issue. There is no amendment in this point. Next, he has hired 6 employees on 16/4/24 for both the businesses. He is treating both the income, house property and manufacturing of footwear, as business. So he is saying, for both businesses I have hired employees, 6 employees, and out of this 2 employees are exclusively for house property, like they will search for the customers for him, they are doing the advertisement for him. So basically they are not related to the business as per the assessment laws. Now he paid salary of 22,000 to each employee per month, and also contributed 3,200 per month for each employee into the pension scheme. Now there is some limit for pension scheme and provident scheme and all these things. Whatever contribution he can make. So that we'll see in the solution. 14% is the allowed limit now. That is an amendment. We'll see in the solution itself. He also received remuneration from a firm, Kishan and Company. This names I have taken randomly. It has no connection with any known person. Remuneration is received by him. He is a partner over there. 60,000 per month is the remuneration, and book profit of the firm is 8 lakhs. So now seeing this point, one thing should come to a person's mind, that he is earning salary from the firm. So for firms, some amount is allowed, some amount is disallowed. Why this point is covered over here in individuals? Because whatever is allowed in the hands of firm, it will be taxable in the hands of partner. We will see how it has to be calculated while doing the solution. He has some following capital gain transactions. I have taken total 12 examples of capital gains because capital gain is the major thing what has been amended by this budget. This one by one we will go when we see the solution. This land and building, in K point if you see, there is a land and building sold by him on 10/10/24. So for this there is some extra point that co-ownership is there with Mr. G, and consideration in respect of Mr. G is 39 lakhs. So this means that whatever 26 lakh is mentioned and whatever amounts are mentioned over here, it is for Mr. A and not for any other person. It is not cumulative with any other person in co-ownership. And SDV of the property is 72 lakhs. This is the capital gain point. We'll see. Cost inflation index is given for different years for different parameters. Moving forward to next point, he also acquired 1,000 shares of a listed company, and those shares were bought back by the company. So there are some new rules regarding buyback of shares. If a listed Indian company buys back its own shares, then now it is taxable in the hands of investor from 1st October 2024, like for any buyback happening on or after 1st October 2024. Next point, he is also a director in a company where he has earned 15 lakhs and 8 lakhs for not sharing any know-how of the company. So now there is also amendment 194C and 194J. Earlier, if we see the word contract, then we used to say it is 194C and lower TDS will be deducted. But now this amendment has been brought that whether it is contract or not, we will see the purpose. Know-how. The contract is entered for know-how. So this non-sharing of know-how is a business income. So TDS should also be deducted under business head, professional head, like 194J. Coming to the next point, he earned some interest from 2 bonds. We will see the limit of 10,000 because few bonds are exempt from TDS if the limit of interest earned is up to 10,000 rupees. Then he donated 8,000 rupees to PM National Relief Fund and National Sports Development Fund each. So there is something new for National Sport Development Fund. We'll see in the solution. He has not opted out of section 115 BSc, which means he is going for the new regime, and we have to compute his tax liability and we have to give the effect of TDS also, because it is mentioned TDS has been deducted at applicable rates wherever required. Let us go to the solution. I made the solution in the Word file itself. Now, coming to the first point, income from salary. We'll calculate the income from all the 5 heads. Income from salary. So he is earning a gross salary of 12 lakhs and 1,82,000 was contributed by the employer towards pension scheme. So as discussed earlier, these two form part of his income and contribution to provident fund won't be considered over here. So if you see gross salary 12 lakh plus 1,82,000, so it is 13,82,000. And if you are going for the new regime, then now there is an amendment. You can claim 75,000 as standard deduction. But if you are going for old regime, the standard deduction remains the old one, 50,000 rupees. So 13,07,000 is his salary income. Coming to the house property. House property, it cannot be treated as business, though the assessee wants to show it as business income or claims it to be the business, but tax has to be calculated under house property income itself. So his gross annual value will be 56 lakhs. He will be allowed municipal taxes 75,000 and standard deduction of 30%. So it will come to 38,67,500. So these two, salary income and house property, was plain. So coming forward to the business income, he has earned footwear manufacturing business. So what is happening over here? One extra check is there that he's earning 3 crore 20 lakh, but out of that 20 lakhs, which is more than 5% of 3 crore 20 lakhs, is earned in cash, is received in cash. So that is the point here. 44AB tax audit will be applicable on him. So this is just an additional check for this point, whether you know about it or not. So this is his income. Next, he earned some income for not sharing know-how. This is also a business income for him, and TDS will be deducted under 194J for this. So this is an amendment. That TDS will be deducted under 194J for any income earned related to know-how. So he earned 15 lakhs and 8 lakhs. 23 lakh is earned by him. Now the TDS provision will apply accordingly on 23 lakhs. The next one, the one more income is earned by him. If you remember, he earned some remuneration from firm, and we have given book profit of 8 lakhs in the question. Why this book profit is important? Now coming to this point, this is we'll understand in detail. If any person is paying any amount, is receiving any amount from a firm as remuneration, then there are some limits. These limits have been changed. Earlier these limits were, if the book profit is up to 6 lakhs, then up to 3 lakhs, then 1,50,000 or 90%, whichever is higher, was allowed to the firm as reduction claimed for salary paid to partner. And if any book profit remaining, means above 3 lakhs was there, then 60% on that cumulative total amount was allowed to the firm, and it was taxable for the partner. So in our case, SSE is the partner. Now this limit has been doubled. Earlier it was up to 3 lakhs. Now if book profit is up to 6 lakhs, then 3 lakhs or 90%, whichever is higher, will be allowed for firm, and if book profit exceeds 6 lakhs, then on that excess amount 20% will extra be allowed to the firm for claiming remuneration paid to partner deduction under section 40 subclause B. Coming to this point, he earned 60,000 salary from the firm. Now we are talking from the perspective of the SSE individual. So whatever is allowed to firm will be taxable for him. Book profit of the firm is 8 lakhs. So up to first 6 lakhs, 3 lakh or 90%. 90% of 6 lakhs is 5,40,000. So this 5,40,000 is taxable for him because it is allowed to firm. Now book profit is 2 lakhs excess of 6 lakhs. So 60% of that is also taxable for him because that is also allowed to firm as reduction. So total 6,60,000 will be taxable for him as this amount has been allowed to firm to claim deduction. But he has received 7,20,000. So 6,60,000 is taxable in his hands. Remaining 60,000 is taxable in the hands of the firm. So his business income will be 3 crore 49 lakh 60,000 in total. But this is only the income portion. We have not deducted the expenses for him. Coming to the expenses part, first we will see the contribution to pension scheme, then we will see to salary to employees. Contribution to pension scheme, he can claim as business expense up to 14% of the salary paid by him. He paid a salary of 22,000 per month to each employee. But there is a catch. If he has to take exemption for contribution to pension scheme, then he can claim it only for the employees who are engaged in his business activities, like his business employees. So his business employees are only 4 in number, and he has given them salary 12 months. So now what will be the amount of contribution he can claim? 22,000 into 14%. This is an amendment. Earlier this point was applicable, 14% was applicable only for government employers, but now it is applicable in case of non-government employers itself also. So for 4 employees, he will be allowed to 14% of the salary paid to them as contribution to pension for the full year or for the duration for which he has paid the salary. This is assessment specific amendment. So this will apply for the full year transaction. So we have made the calculation. 4 employees into 3080 rupees per month into 12 months, because the salaries were paid on 16th April 24. From that date the people were employed. So 1,47,000 will be the total deduction in respect of this. Now coming to the salary to employees, this is a contradictory point, that whatever salary he is paying 22,000, he can claim all our business expenses. 22,000 into 12 is clear, 22,000 per month into 12 months, he can claim it. But for how many employees? The person says this is my business expense. While preparing his P&L for the year, he might have shown it as business expense for all 6 employees. So this business expense salary deduction is as per P&L. So we are taking full, but there might be a contradiction that it should be allowed for 4 SSEs, 4 employees. So what is the point over here? You can take both the aspects. Both are correct according to my understanding, because he is claiming that in my P&L I am paying salary to all my employees, whatever it might be, because he is considering it as business. During the year, whatever he has earned from house property, he treated it as business only. So after these deductions, business expenses, after reducing the business expenses, his income is coming to 332,28,160. Now coming to the capital gain. Capital gain is a major area where most of the amendments have been brought in. This is most confusing because there are different dates and different rates have been changed, short term, long term, whatever it might be. So we'll go through a summarized tab I have made for this. Whatever, first we'll understand what amendments have been brought in. Then we'll go to the question. One by one we will deal with it. In capital gain, relevant for this point, only 4-5 amendments are applicable, like whatever it is there. Some meanings have been changed. The first thing being the long term short term classification. Earlier it was 1 year, 2 years and 3 years. Now it is only 1 year and 2 years. The 3 years criteria, 36 months criteria has been removed from the period for checking the period of holding. Now section 111A, that is short term capital gain from the share market, like listed shares, units, listed units, those things. So if the cutoff date is 23rd July, in capital gain, the most of the places for this long term and short term capital gain, the cutoff date is 23rd July. So if any income is earned, if any transfer has happened of capital gain, capital asset before 23rd July, then old rate will apply. And if transfer is happening after 23rd, on or after 23rd July, then new rate will apply. Same happens with 112A. But in 112A, there is one more change, that you can claim 1,25,000 on whatever income you earn during the year. This 1,25,000 is assessment specific, but this rate changes date specific because it is dependent on the transaction which is transferred. These two are the plain short term and long term capital gain from the securities market. Now coming to the income of long term capital gain on income earned other than securities market. 112, section 112. Now we'll focus only on the resident portion over here, because our main focus is residents. See, in this, what is the case? Resident individual and HUF, if they transfer any asset other than land and building, and transfer is happening before 23rd July, then he has to pay tax 20% with indexation. And if transfer is happening on or after 23rd July, then he has to pay tax at 12.5% without indexation benefit. So the cost indexation benefit, he won't get it. In this case, if asset is other than land and building, if the asset is land and building, then he has option. He can go for 20% with indexation or 12.5% without indexation. It is his choice, whether the transfer is happening before 23rd July or post 23rd July. Coming back to the solution, this was the point. So this has to be taken care while solving the solution. Basically this says that deduction whatever he can claim, like whichever option he chooses, it is for the transfer after 23rd July, basically in the practical world. Coming to the first point, we'll come to the question. First two cases we'll take together. We'll take lot by lot. First two cases. These two are shares of listed company. So he has acquired these shares in May 2024 and he sold these shares in June and August 2024 respectively. So if you see here, both are short term. It is very clear, it is less than 1 year. So both the shares are short term. But one is sold prior to 23rd July and one is sold on or after 23rd July. So what will happen in these cases? So different rates will apply. Both are short term but different rates will apply. On transfer A, rate of 15% will apply because it is sold prior to the cutoff date. On B, it will be 20%, the new rate, because the rate has been changed from 15 to 20% by the amendments in Finance Act. If you check here, shares of listed company, it is short-term capital asset which is sold prior, so tax rate is 15%. So we'll take value of consideration minus cost into the number of shares. Same way we will take it here, but tax will be at 20% in point B. Now coming to listed units. What does the question say? We'll cover C, D and E. What does the question say? That he acquired some listed units on 24th July 24 and he sold them prior to 23rd July. So it is short term, it is very clearly evident. Now there is an amendment in this. Earlier, if any listed securities other than units were sold within 1 year, that were considered short term. But now the word other than unit has been removed. So any listed security, whether it is units or shares, if transferred within 1 year, then it will be treated as short term. Now, what does this transfer specify over here? If the transfer of listed unit is happening post 23rd July and the total holding period is less than 1 year, then this will apply. Then we will check 1 year criteria for this. But if transfer is happening prior to 23rd July and total period of holding is up to 1 year, then we won't check the new condition. We will go by the old condition. That other than unit, if it is 1 year, then it will be considered as short term. So now coming to the solution of these three listed units. 24th June it was purchased. It is a short term because it is sold prior to that, so it is short term. Then 25th July it was purchased and it is sold on 6th August 24, which means it is more than 1 year. So it is long term because we will see the condition of long term. If transfer is happening after 23rd July, that 1 year condition will be checked in this case. Third case, it is short term because in May 24 it was purchased and sold post 23rd July. So again it is short term. We'll see how rates will apply on this. The first case, listed unit, it is a short term capital asset because it is sold prior to that. So we won't see the period of holding condition, new condition, and it will be taxed at 15% over here. It is listed units, so 111A will apply in this case. Point D, listed units. It is a long term capital asset because it is total period of holding is more than 1 year. But it will be taxable under 112A, that is clear. But the tax rate will be 12.5%. Why? Because it is sold after 1 year and new condition we will check. It is short term only if it is sold within 1 year because it is a listed unit and this is an amendment in this finance budget. There are two other points over here that 12.5% rate will apply and exemption of 1,25,000 will apply in this case because he is paying taxes under 112A. Coming to the E point, listed units. This units is short term and it has been transferred post 23rd July. So it will be taxed at 20%. So this is simple. So now this 85,000 is taken separately because we have to give the benefit of 1,25,000 from this. So total 1,25,000, like this total 85,000 we can claim in 1,25,000. So taxable listed units the T point, no capital gain will arise. No tax on this will be arising and we have still some 35, 40,000, 1,25,000 limit remaining with us. Exemption limit remaining with us. Now coming to the next, F and G, shares of listed company. These shares are long term because both the shares are purchased in 2023 long back and it is transferred beyond 1 year, 24th July. One is beyond 23rd July, one is before 23rd July. We'll see how it has to be treated. It is very clear that both are long term capital gains. There is no issue in this. But one is sold on or after 23rd July. So it will be taxed at 112A, 12.5%, and exemption of 1,25,000 will apply. Whenever we give exemption in capital gain chapter, we will give always on the beneficial side of the SSE. We'll see the beneficial part of the SSE. Wherever SSE is getting the most benefit out of it, we will give accordingly. So we had a limit of 40,000 remaining from this 1,25,000. 85,000 was exhausted, then another 22,950 we can exhaust over here. Coming to the next part, this is also a long-term capital asset. This point, just F and G are just different because of the rate of taxes. The exemption and everything is same, just the date of transfer changes the rate of taxes on this. Otherwise it is one and the same, and 1,25,000 is allowed because both are shares of listed company, and 1,25,000, as I told, it is assessment specific and it will apply for all the income earned during the year, whether the transfer is before the cutoff date or after the cutoff date. So F and G are same. Just to show some exemptions, just to show some tax in this 112A, I have taken this example. So 85,000 and 22,950 we are claiming over here, and there is some amount 22,950 of income over here, but total cannot be claimed because we have a limit of 1,25,000 only. So 6,685 is taxable. So we have shown it like this: 85,000 then exhausting it, 22,000 then exhausting it, which means nothing will be taxable in these sections, because here if you see it is 12.5% for the SSE. Here also it is 12.5% for the SSE. So here he has to pay more tax. So first we will give the benefit under higher rate of tax. Then whatever is remaining income is there under 10%, he can pay the taxes on that amount. Coming to the next part, H and I, those are for unlisted shares. So unlisted shares, whether it is short term, long term, we cannot go for 111A, 112A. We have to see 112 if it is long term. So in our example, it is 112 because both are long term. It is purchased on 2011 and 2014 and sold during the year financial year 24-25. One was sold prior to 23rd July, one is sold on or after 23rd July. Let's see in the solution how it is done. Unlisted shares, both are long term. We know it that it is a long term capital asset in both the cases. The first one, it is sold prior to 23rd July, so it will be taxable at 112 and 20% with indexation. So prior to that, 20% indexation benefit will be given. Second case, I, it is 112 because it is long term unlisted shares and it is sold on or after 23rd July. So no indexation benefit will be given. There is no choice if it is unlisted shares. If it is any asset other than land and building, he cannot go for choice that I have the choice to claim 20% with indexation or 12.5% without indexation. He has to pay tax 12.5% without indexation. So it has been calculated accordingly. This is for the unlisted shares. Now coming to the major amendment portion, land and building in capital gain. Three cases I have taken over here. Case K is related to something to co-ownership. Here some old existing provisions will also apply in this case. I will explain it. So what is happening over here in land and building? All the land and building, see, earlier land and building period of holding was different. Earlier long-term capital gain for land and building was for 2 years. Period of holding was checked 2 years, and now also it is same. So there is no amendment in period of holding for land and building. Now we'll see all three cases one by one. The case J, land and building purchased in 2015 and sold on 16/6/24, which is prior to 23rd July. So old law will apply. He can pay tax 20% with indexation benefit. long-term capital asset which is sold prior to 23rd July, taxable under 112 at 20% with indexation. In this case, there is no point of option because transfer has happened before 23rd July. So 56,300 can be is total capital gain on this property. Second one, K. K we will come at the end. We'll see L first. What is happening in L? L is purchased 4/9/22 and sold on 10/12/24. So it is sold post 2 years. So actually for any other asset which is not covered in 1 year and 2 years, those things now the holding period has to be checked only 2 years. Don't go for land and building because land and building earlier also 2 years was there, now also 2 years. So there is no amendment for land and building period of holding. So this is just to check this point whether you are seeing 2 years or 3 years for land and building. So it is 2 years, after 2 years and post 23rd July. So option will come. He can pay tax on long-term capital asset, indexation with 20% tax indexation benefit or 12.5% without an indexation benefit. See, long-term capital asset which is sold on or after taxable at lower of 20% with indexation or 12.5% without indexation. Why lower of? Because again we give the benefit to the SSE. So we have calculated. Once we calculate the option which is available to the SSE, we will see with cost. So 16 lakh is the value, consideration value, and 12 lakh is the cost. So if indexed cost we calculate 20% with indexation, so his tax should be 56,797. That is a tax. But at 12.5% without indexation, he is getting a tax of 50,000 only. So we will go for this, and income for this. This is the tax amount what we have calculated over here to check where he will go. So income will be 16 lakhs minus 12 lakhs. So he won't get the benefit of indexation because he is getting tax benefit in this case. So he will choose 12.5% without indexation. Now coming to point K, what has happened over here? There is something called co-ownership. There is an amendment that co-ownership, wherever co-ownership exists, then the condition of 50 lakh criteria, 50 lakh stamp duty value and 50 lakh consideration under 194 IA TDS won't be checked for each co-owner. It will be checked cumulative. So in this case 26 lakhs consideration is for Mr. A and 39 lakh for Mr. G. So which means total 65 lakh consideration is there. Now what is the importance of this 65 lakh consideration and stamp duty value of 72 lakhs? 65 lakhs into 110%. If stamp duty value is up to this limit, then consideration what I am claiming, what the SSE is claiming will be the consideration and treated as gain. But if stamp duty value is more than 110% of the total consideration, then my stamp duty value will be the fair value consideration and I have to pay tax on that. But TDS will be deducted on the amount paid to the co-owner, like in this case 26 lakh and 39 lakh. Now coming to this solution, if you see over here 65 lakh is the consideration. So stamp duty value, if it is up to 65 lakh plus 10% means 6.5 lakhs. So if stamp duty value is up to 71.5 lakhs, then we can say my consideration is 65 lakh only. See, 10% is just for the check condition. It does not mean that you have to increase the consideration by 10% and show it as value. But if stamp duty value exceeds that, then you have to take stamp duty value as the consideration. So basically whenever your stamp duty value is more than 110% of the consideration, then your taxable gain, whatever you are earning, taxable consideration is increasing by at least more than 10% of your consideration. It is not increasing by just 50,000 or 1 lakh or just the 10% amount. At least more than 10% amount, it will increase your consideration and accordingly tax will increase. Now, in this case, it is plain that he can choose the option. But what about co-ownership? What will be the income? What will be the portion of income of both the co-owners? On what amount we have to calculate the option available to Mr. A? Both are co-owner and their ratio is 2 is to 3 because it is implied 26 lakhs and 39 lakhs. It is 2 is to 3. So total we will see, and SDV 72 lakh is the consideration now. So 72 lakh will be bifurcated. On that they have to pay tax. Then we will see which option is better for him. So 72 lakh is the consideration, and out of that 72, 40%, 2 by 5 is Mr. A's share. So Mr. A will show 28 lakh 80,000 as fair value of consideration in his ITR. And now on this amount, he will check whether 20% with indexation or 12.5% without indexation should be opted by him. So Mr. A now in 20% indexation, cost was 18 lakhs. So he has applied indexation 363 by 254. You can check the indexation rates. That is very plain. The year of indexation, financial year, cost inflation index is provided over here. Year of acquisition is the indexation for year of acquisition will apply. In this case, K case, it is 254 because it is purchased during the year 15-16. Now coming again to this. So 20% tax with indexation is calculated. 28 lakh 80,000 is his share in the consideration, and 20% tax. So 61,000 is the tax in this case. Now 12.5% without indexation. So direct cost will be reduced, but tax will be at 12.5%. So if you see here, the 20% with indexation benefit is beneficial for him. So accordingly, he will show his gain. Now his gain will be 28 lakh 80,000 minus indexed cost. The calculation is over here. 2572. This is the 2572. 18 lakh into 363 by 254. So his gain from this is 3 lakh 7,000. Some change. L we have already seen. Now this is the capital gain. Major things have been done for capital gain. Now coming to the next part, part 5. Here's something, if you see, buyback of shares is there. Now new section, section 2, subsection 22, clause F has been introduced. What does this section say? If any buyback has happened, if any listed Indian company is buying back its shares on or after 1st October, then tax will be paid. Whatever amount the SSE is receiving, tax will be paid by the SSE on that amount, full amount. But now SSE will say, when I purchased the share, I did not know about the buyback. That company will buy back the shares. What about my cost of that time? I paid some amount to buy the shares. Allow me that. So the department said that no, whatever tax you are paying on buyback is income from other sources. So you cannot claim it from there. But whatever cost you have incurred earlier, it is dead loss for you. So we will allow it in long-term capital loss, like other long-term capital loss, and you can set it off for 8 years. See here, long-term capital loss, cost of acquisition of shares bought back on or after 1/10/24 is capital loss and carried forward for 8 years. Now it is 2,60,000. How we came to 2,60,000? He paid 650 for each share. This is the purchase price for him. Now the buyback of 400 shares has happened post 1st October 24. Earlier, if any buyback is happening prior to 1st October, then SSE is not liable, investor is not liable to pay any tax on that. So only 400 shares were bought back post 1st October. So cost of this 650 rupees per share will be allowed to him to claim capital loss. So 400 into 650 is allowed to him, 2,60,000, and he had long-term capital gain. We know long-term capital loss can be adjusted only against long-term capital gain. So we have long-term capital gain sufficiently to adjust it. So it is adjusted, and he is getting around 7 lakhs as total capital gains. Now income from other sources. As we see, dividend will be there. Why? Because of the new section. Buyback of shares prior to 1st October 24 is taxable in the hands of company and has nothing to do with it. So 115 QA will apply and company will pay tax on that. That is plain. But if buyback is happening on or after 1st October 24, then it is taxable in the hands of shareholder. And the gross amount will be taxable as dividend because he has already claimed long-term capital loss in capital gain head. So 400 into 902, because 902 was the buyback price by the company, if you can see here. is dividend income for him and it has been taxed to him. Now, interest from bonds. He has received some interest from bonds. Both are his income. 19,000 has been earned. This is plain. Interest has been earned and he has shown it as income from other sources. Some point in TDS will come for this. We will see it. So gross total income is 3 crore 94 lakhs. 77,445. Now, coming to deductions. He made 3 eligible deductions under Income Tax Act. But only 2 are allowed to him. 1 is not allowed because he has opted for new regime. Now, we will go over the by 80G first, the last one. Why? Because this is plain and no, it is not allowed. Only one change is there. Earlier, National Sport Development Fund was not added in donation list. Now it is added that if SSC makes any donation to National Sport Development Fund, that also can be claimed by him. But he is opting new regime, so it won't be allowed to him. In our case, coming to 80CCD2, what does it say? Any SSC can claim 80CCD2. Don't confuse it with the employer contribution and employee contribution. 80CCD2 says your employer is contributing anything to your funds. 36(1) what we have claimed earlier above is this one. 36(14) is for what we are providing to our employees. So both are different. So his employer contributed 1,44,000, but it is allowed to the extent of 14% of his salary under new regime. So 12 lakhs into 14% is 1,68,000. So 1,68,000 should be allowed, but there is a limit of 1,50,000 on this amount, and he can claim only 1,50,000. If 80CCD1B was allowed to him in under old regime, then he might have claimed 10% because see, two things are there: 80CCD1B and 80CCD subsection 2. So under 80CCD2, if he is going for old regime, then then for non-government employer he can claim only 10% of the salary, but he can claim additional 80CCD subsection 1B 50,000 rupees in this case. But if he is going for new regime, then he will be allowed 14% of the salary. That is for sure, up to a limit of 1,50,000. But 80CCD subsection 1B won't be allowed in this case. Same thing is mentioned under old regime, it is still 10%, but there would have been benefit of 80CCD. So if he would have opted old regime, then 12 lakhs into 10% plus 50,000. So restricted to maximum of 2 lakhs, but he has contributed only 1,68,000, so 168 full would have been allowed in old regime. But now in old regime, new regime, he is being allowed only 1,50,000. Coming to next, we saw something in business income, manufacture of footwear and hiring of employees. Now, there we took business expense 6 employees. There was a contradictory point I told you. But 80JJAA says that whatever you are claiming for business, for new employees, you can claim 30% of that amount. Whatever you are paying to your employees can be claimed, but there should be additional employees and those should be related to business. Now, one more condition has to be checked. They are told as new employees only if they have been hired for a period of 240 days or more. 240 days or more during the financial year. So that has to be checked. But there is one change, that the period of 240 days will be read as 150 days if the business is manufacturing of footwear, leather or other products, other leather products. So in this case it is manufacturer of footwear, so we'll see the condition of 150 days, and he has hired the people for more than 150 days because they were hired in April 24. So full amount can be claimed by the SSC, Mr. A. 30% of the full amount paid by him can be claimed. So for 4 business employees, 22,000 was paid for 12 months and 30% is claimed by him. So 3,16,000 can be claimed. 80G is already discussed. So taxable income will be 3 crore 90 lakh 10,645 after these deductions under chapter 6A. Now, calculation of taxes. These are very plain. There are no changes apart from the slab in these cases. STCG is plain. A and C. We'll just go through it quickly once. A and C, shares of listed company, short term and short term. Taxable at the rate of 15%, 66,000 plus 30,888 into 15% has to be taken. Same thing is done over here. STCG at 20%, short term capital assets but transferred after 23rd July. So it is B and E. If you see here, short term and short term but sold on or after, both the cases sold on or after 23rd July. So 20%. Moving forward, 112A at 10%, which is prior to 23rd July, and 112 at 20%. Sorry, 112A at 10%, DFG, 3 cases. We have given the benefit of 1,25,000. This one 85,000, 22,950, and this 22,950. So we were having 6,685 into 10% as the taxable amount. Then 112 H, J and K. H is here, J is here and K is here. So these three income we'll consider over here 112, and then we will allow, see now what is the case, we have some long term capital loss that can be set off by him, 2,60,000. How it will be set off? See here, 112, it cannot be set off from 112, it can be set off from 112A also. So it will be set off from the highest rate of tax, where he is paying highest rate of tax. So in these long term 112A, 112, if you see 112 is at 20%, is having the highest rate of tax. So first he will exhaust this 2,60,000 from here. In our case, he had the limit, he exhausted full 2,60,000. If this was not the case, if this was not sufficient, then it will go to this. Suppose 40,000 is remaining, only 2,20,000 is claimable over here. So he will go to this. If anything is remaining, then he will go to this. But if anything else is remaining, then it will be carried forward and it cannot be taken to STCG and STCG. So accordingly, his taxes on capital gain will be 1,03,000. Other income we are calculating at slab. Slab rates have been changed. It is 3 lakhs nil, 3 lakh to 7 lakh 5%, 7 lakh to 10 lakhs 10%, 10 lakhs to 12 lakhs 15%, 12 lakhs to 15 lakhs 20%, and above that 30%. This is only for the new regime. Old regime, the rates remain same. Now, what is his total other income? Total income was 3,90,000, 3 crore 90 lakhs, and capital gain was 6,94,000. So the remaining income is 383,115,660. He calculated taxes. Accordingly, taxes as per slab is coming this much. Now his total income is coming more than 1 crore and even more than 2 crores. Something for surcharge will come in this case. Now, how surcharge is calculated? On long term capital gain and short term capital gain under 111A, 112A and 112 plus dividend, surcharge will be at 15%. It cannot exceed 15%. Now what the surcharge rule says? If your income is more than 50 lakhs, then 10% surcharge. If your income is more than 1 crores, then 15% surcharge. If your income is more than 2 crores, then we will check the conditions. If your total income exceeds 2 crores and your capital gain income or special rated dividend is there, then we will apply surcharge. The surcharge on these 4 sections, dividend and capital gain sections, cannot exceed 15% in any case, whether it is 2 crores, 5 crores, 1 crore, whatever it might be. But if your total income exceeds 2 crores and apart from these income, apart from special rated these income, if your income is more than 2 crores, other income is more than 2 crores, then surcharge will apply at 25% in these cases. That is the maximum limit in new regime. So on tax under 111A, 112A dividend, we have taxes of 103,259 on capital gain. This one. And proportionate we will calculate because the dividend tax is calculated at slab, but surcharge is calculated at special rate. So this tax of 1 crore 11 lakh 84,698 includes my dividend. So dividend tax on dividend. So tax dividend income is 3,60,000. So we will consider it like this. So 3,60,800 we have taken as dividend. Proportionate we have taken. If one for 1,18,000, whatever tax is that, this is the proportional calculation. 15% we have applied on it, tax on it, surcharge on it. So my total other income is this much, on which I am paying taxes this much. But some amount is pertaining to this dividend income also. So accordingly we have calculated, and the remaining amount is here 2769. So total surcharge will be 28,01,130. Then cess will be added, and 1,46 lakh will be the tax liability. Now TDS are deducted. Now we will see how TDS is to be deducted. On salary, it has been deducted at slab. I have taken an assumption over here that he has not disclosed any other income to his SSC. Whatever salary income he is earning, he has disclosed only that much, and he does not have any income or expenses other than that, as per the mindset of his employer. So TDS has been deducted only on the salary that I have taken over here. So it is 50,000. Why? Because I have just done a rough calculation over here. See, his salary income is 13,07,000. So he is falling under this bracket. So now slight changes are required. There was a small mistake. So 192, how we have calculated, his income was 13,07,000. So he is falling under this bracket. So I have taken whatever is in excess of 12 lakhs. So 1,07,000 into 20% plus 4 lakh into 5% here 20,000 plus 3 lakh into 10% 30,000 plus 2 lakh into 15% 30,000. So total 80,000 I have taken over here. So this is just a rough calculation, slab by slab I have not done it over here. So 1,01,000 is over. This is the TDS on salary. Now 194J, as I told, know-how is a business income. So any TDS relating to know-how, whether under a contract or not under a contract, the TDS will be deducted under 194J at the rate of 10%. So 23 lakh was his income for contractual. Here it is. So 10% of this 2,30,000 will be the TDS. Now 194 IA, Mr. A's share, as I told, the consideration was 72 lakhs because it was exceeding 110% of the consideration. SDV was exceeding it. So, but whatever amount was paid, the consideration was calculated, tax was calculated from SSC's point of view. But the person who is paying the amount will see whatever he is paying to the SSC. On that he will deduct TDS. So TDS will be deducted only on 26 lakh in respect of Mr. A. So it is 1% of 26 lakhs, which is 26,000. Now coming to the last section 193, there are two bonds, 8% saving taxable bonds and floating rate saving bond. These two cases, if the interest amount is up to 10,000, then no TDS is required. But if it exceeds 10,000, then TDS is required. So 8% saving taxable bond, it is below 10,000, so no TDS is deducted. But floating rate bond, it is more than 10,000, so on that amount TDS is deducted. The TDS won't be deducted on full amount. Why? Because whatever we deduct TDS, if it is received from the single party, both the amount, then total 10,000 will be checked. If bank or any bond payer is giving you the interest, then total will be checked because it is PAN basis, one to one person. If I am receiving any interest from any person under 193 which are eligible, so if it is more than 10,000, then he has to deduct TDS when he is paying me more than 10,000. So this is the case. So total deduction of TDS will be 358,700 and his net tax liability will be 1,42,93,950. Hope this clears all your doubts. If you have any doubt, I have given the description of my Telegram and LinkedIn over there. You can contact me directly if you have any doubt, or if you have any suggestion or any point where I need to make corrections, please let me know. Thank you.